Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Wow, don't we live in interesting times? Hasn't the last week been particularly interesting? I recorded a podcast last Monday about the Trump tariffs, and only a few days later, it seemed that the impact of those tariffs had been somewhat diluted from the market. That is, the market recovered strongly. Who knows what is in the future? But kind of good timing, this topic, which I was writing about maybe a couple of weeks ago, about the Australian stock market. So, last year we had a pretty good return, not as good as the US market. About 11.5% the ASX 200 returned in the 24 calendar year. But the problem, and I've spoken about this, I spoke about it in January, the problem was that, three banks in CBA, Westpac and NAB generated most of that return, about half of that return, 6.5%, actually more than half really. On the other hand, the big mining companies in BHP and Rio were actually a drag on the index. BHP fell by about 19% over 2024 and Rio about 12%. So the problem is that if you're going to invest in the ASX 200 index, what you really need to do is form a view on these large cap stocks. So really the big banks, BHP and Rio, so the big miners. Then you've got CSL, Wesfarmers, Telstra. I hope I haven't excluded anywhere else on that, but that makes up a substantial part of the index. So if you're going to use an index fund like VAS or A200, they're two ETFs that either invest in the ASX 200 index or the ASX 300 index. But if you're going to use traditional market cap indexing, what you really need to do is form a view on what will these large cap stocks do over the next period of time, and therefore should you employ different indexing approaches to sort of accommodate that risk. Now, I guess if we kind of overlay what might be happening overseas, in the US and so forth, it might actually make it more attractive to invest in the Australian stock market, because whilst we will be impacted if there's a global recession or something like that, whilst we will be impacted, of course, maybe not as impacted by as some other jurisdictions like perhaps Europe and China, of course, and other jurisdictions like that. Australia will be somewhat, well, at least at this stage, because it's hard to predict, at least somewhat protected. Also, the banks had a big run last year. The share prices did incredibly well. And so I think it's important to then think about how will the banks contribute to the index's return this year? Because again, it might help you decide to use different indexing approaches. So today what I want to do is go through that. I wanted to talk about the banks, let's say the big five banks, including Macquarie. And then I'm going to talk about the big miners because they had a bad year last year. The banks had a good year last year. And then I will sort of talk about some of the other sort of top 10 stocks. Actually, Goodman Group is one that I didn't mention as part of the top 10. And then I might talk about, how you might build a portfolio that invests in the Australian market that kind of accommodates some of those risks. And in doing this, it will be useful for people that own direct shares. Now, I don't own any direct shares. Actually, it's a lie. I do own some CBA. It's some stocks my wife bought many, many years ago. We've been gradually selling down that, but I don't buy direct shares because I eat my own cooking. I say that, picking direct shares is a bit of a fool's game. It's really about picking indexes and using a rules-based, evidence-based approach, as I talk about in the podcast all the time. But of course, we have a bunch of clients that have invested in direct shares before they've come to us. And so, they could be actually large holdings in their portfolios. So we then need to think about how we're going to transition to a more rules-based approach over time, whilst trying to minimize CGT and any tax consequences as much as possible. So I think this podcast might help those people also that hold some of these direct stocks and are thinking, what should I do? Should I continue to hold them? Should I strategically divest of them and so forth? So let's jump into it. Let's start with CBA because it's a bit of the market darling. It's about more than 11% of the index. It sort of wanes between 10 and 11%. Pretty significant bank, pretty significant holding. And in fact, Morningstar early this year concluded that CBA was the most expensive bank globally. Now, if you have something that is, let's term it overpriced, you probably should take profit. Like if you've got an asset that's trading above its intrinsic value, at some point the market's going to work it out. Mean reversion will kick in and the value will contract typically. Now, CBA is undoubtedly the best bank, I think, out of the top 5, really. Well, out of any bank in Australia, really. And I think from our experience, I was running a mortgage broking business for more than 20 years. You sort of get that insight and you'll be able to compare banks kind of from behind the scenes a little bit. And they've got superior technology, much better systems. It's got the largest loan book in the country, which is significant because, that's where retail banking drives most of the profit. And they've got a huge customer base, 17.6 million customers, which is a remarkable 64% of the Australian population bank with CBA. It is huge. So it means that it's got access to lots of low-cost deposits, everyone putting their money in the bank and not earning too much interest. And they can then go and use that money and lend it out through mortgages. And it certainly helps their interest rate margin. They've got about 25% of the mortgage market, so well ahead of their second place competitor, which is Westpac at 20%. Now, all these things are important because these are fundamental characteristics that demonstrate why it should be trading at a premium, why it is worth more, and it is a better bank than the other banks. So it was the standout performer in 24. Its share price started the year in 2024 at about $113 and peaked just in February 2025 at $167. And now it's sort of trading back at sort of about 150, 155, depending on the day. So a significant share price improvement. And we only have to cast our minds back to May 2020, sort of 5 years ago, really at the peak of the COVID sort of crash, if you like. It was trading at $60. You've almost got a 3 times, well, not quite, 2.5 times return, if you were lucky enough to buy at the bottom of the market, of course. Now, we use independent research house Lonsec, and they provide the research on stocks and investment products and those sorts of things. And they've got a team that crawls over all the data and interviews the managers, all those sorts of things. So according to Lonsec, its forward PE, forward price earnings ratio, is approximately 24 times, which is well above its long-term median of about 16 times over the past 10 to 15 years. So that's where it normally trades at, 16 times, where it's trading at 24 times. So if we get the mean reversion, or maybe I should be saying when we get the mean reversion, it could mean a 30% price decline. So if it reweights back to a 16 times price earnings, and that's assuming that the earnings don't materially change. Of course, CBA could actually deliver greater earnings than what they're currently to justify a sort of higher value, if you like. But, it sort of imputes how lofty the valuation currently is and the potential downside to investors, both either in a direct stock format or even through an index. Now, I talk about a lot of different indexing strategies in this podcast. One of them is fundamental index. The problem with traditional market cap indexing is that we're allocating our investments across a group of stocks based on their share price, which is really their market value, if you like, and their market value relative to the value of the total index. So as a company share price increases, more of our money is allocated into a particular stock like CBA, for example. So one of the methodologies is fundamental indexing, and what it hopes to do is break the link with price, because price can jump around all over the place. Sometimes price can not necessarily represent intrinsic value, as I'm talking about with CBA. So when we look at the fundamental index in Australia, it only allocates about 6.8% to CBA, whereas the market cap weight index allocates 11%. Now, the fundamental index uses sales, cash flow, book value, and dividends as a measure of economic value, if you like. And so what's that saying, or what that's indicating by comparing those two different index weightings? Again, it's providing evidence to say, hey, CBA's price, share price, overvalued relative to its fundamentals. And again, we should learn something from that from an investor standpoint. The other thing I look to in terms of some evidence, and it's not just one thing that is so compelling that helps me form a view, but it's really about building a body of evidence. And so when we look at the 15 international Australian brokerage firms that cover CBA. So stockbrokers will have analysts looking at these stocks and, again, interviewing management, going over all the financials, all those sorts of things. Well, 15 international Australian brokerage firms cover CBA, and 14 of them either have a sell or a strong sell recommendation on a stock. Now, brokers as a business don't like selling stocks because your money could disappear. You could invest it elsewhere. So, I don't take that lightly. Obviously, the general market consensus is CBA is overvalued. So therefore, what can we learn from that? Well, I think it should trade at a premium relative to the other banks. That's fine. I can get my head around that. But the problem is that CBA had such a significant price improvement last year, contributed a lot to the overall index's return. What's the likelihood of that happening again this year? I'd say very, very low. What's the likelihood of actually it retreating in value? Whether it will retreat back to a 16 times PE, but it might retreat somewhere between 0 and 30% over the course of the year if the market starts believing all the fundamentals with it, and that's going to be a drag on the index. So if I held CBA stock today, I would be taking some profit, absolutely. I think if you can sell at $150, $155, that's a pretty good price. You're getting 24 times future earnings. And I'd be reinvesting that money somewhere else in a more diversified manner. The other thing we need to think about then is the stock that represents 10, 11% of the market probably isn't going to contribute positive returns to the index. So that's something to keep in the back of your mind. I'll come back to that at the end. Now, the next bank I want to talk about is Macquarie Bank. I mean, it's a standout sort of stock in terms of performance. According to Lonsec, shareholders have enjoyed an annualized return of 16.8% over the last decade. So really that's nearly a five-fold increase over that period of time. And so it is a great stock, obviously, from a shareholder's return perspective. When you look at the bank's share price and you look at, say, price to book ratio, which is a commonly used metric, it's trading at, for banks, that is, it's trading at 2.4 times price to book, which is much lower than CBA, which is 3.3 times price to book. And when you look at its earnings per share growth, which is really, how much is it increasing its profit each year? Over the last 10 years, earnings per share has risen by a compounding rate of 9.1%. So it deserves a premium because it's delivering constant earnings growth, or has delivered constant earnings growth, and has certainly delivered great returns to shareholders. Now, when you impute that into a forward PE ratio, it's 21 times, still lower than CBA. But again, CBA hasn't had earnings per share growth, EPS growth of north of 9% either. So I think if I owned Macquarie, I think it's got a very strong, solid performance of delivering great returns to shareholders. I don't think I would change my holding too much. I think I'd retain my holding, sort of neutral on the stock, if you like. And as a constituent of the ASX 200 index, you would have to think this year and over the next few years, it's going to contribute positively to that index. Okay, so that's the good news, which is really CBA, let's take some profit, and Macquarie Bank's doing really well. Let's talk about the other three banks. And unfortunately, whilst last year's returns were good, that's where the good news really ends with those three stocks. And in fact, Lonsec calculates that the returns to shareholders over the past decade were 5.6% for NAB, 4.1% for ANZ, and only 3.9% for Westpac. So you've got somewhere between 4 and 5.5% in terms of annualized returns. That's really just their dividends. And essentially, when you look back at share prices, say just before the GFC in 2007, that's some 18 years ago, the share prices are trading at sort of similar levels today. So really, if you bought these three bank stocks, NAB, ANZ and Westpac, in 18 years ago in 2007, your capital value hasn't changed. Sure, you picked up the dividends over that time, which aren't small, of course, they're good dividends, but you really haven't earned much in the way of returns. Now, these banks are forecast to generate good dividends, somewhere between 7.3 and 7.7 on a grossed up basis. So that includes franking credits. So some people go, look, I want to hold these banks because I'm getting those high dividends, and that's fine. But the problem is you're getting those high dividends and your capital is at risk, right? So you could wake up tomorrow and the bank share price drops 10%. Whereas I think you're better off going, instead of going for 7.3 or 7.7%, somewhere in that range, I'm happy to get 6% in terms of income and have more capital stability, which you could do in a fixed interest investment as opposed to a bank investment. Now, currently, these three banks are cheap. Westpac and NAB are trading around a 15 times PE, and ANZ is even lower at 12.4 times. Now, remember, the long-term average is around about 16 to 18 times. So you might look at that and go, well, they're too cheap. I'm not going to sell them at this price. But they're cheap for a reason. They're cheap because the returns over the last, let's almost call it 2 decades, have been really poor relative to, say, a CBA or a Macquarie Bank. So I think that's what the market's trying to factor in, is that if you invest in these stocks, sure, you might pick up the dividend yield, but there's no expectation necessarily of any capital growth. And as investors in the stock market, we want a combination of income, but we also want compounding capital returns as well. Now, if we're just investing for income, I would argue that a safer way of going about it is fixed income. So bonds, hybrids, these sorts of things, as opposed to investing in direct stocks. So if I held Westpac, NAB or ANZ, I would look to reinvest those monies elsewhere. And remember, if you're going to invest in an index, so if you've got those direct stocks, you say, I'm going to sell them and I'm going to go buy an index, you're still going to have some exposure to these banks anyway. So if they do recover, you're still going to pick up that upside, but at least you've got a more diversified rules-based approach. Now, as I said at the beginning, it's important to form a view around the big miners in Australia because they're so large, and we've got two of them, BHP and Rio, that really sort of stand out and that were a drag on the index last year. But if the miners have a great year, and even if the banks don't do much, the index tends to have a pretty good year too. So they're really influenced, these two companies are really influenced by kind of three main factors. Commodity prices, and that's mainly sort of iron ore and copper, and we'll get into that. Global demand for commodities, particularly from China, and of course the movement in the Australian dollar. Whether the Australian dollar is cheap like today, that helps obviously from an exporting perspective. If our dollar becomes expensive, of course that doesn't help so much. So let's talk about each of those three factors. Let's start with commodity prices. So at the start of 24, the iron ore price was around about 120 US dollars per tonne, and it dropped to a low of about 90 US dollars in about September 24, and it's currently around 100-ish dollars per tonne. So you can see that the commodity price has really contracted. And over recent years, the trading range is really about $90 to $150. So there's been times when iron ore price is very high. Of course, BHP does really well in that situation, particularly if China's buying a lot of that iron ore. So it does have some headwinds in that, in the past it's traded relatively high and it looks like it's kind of retreating a little bit. And there's a couple of reasons for that. Firstly, China tends to stockpile. So in September, when it reached $90, they bought quite a bit of iron ore. And so their stockpiles are quite high. Plus also demand in China is a lot lower. Of course, they're dealing with a pretty dismal property market more correctly. And so they don't need as much steel because they're not building, they're not constructing as much and so forth. And so some analysts are predicting that the iron ore price might actually retreat back down to sort of 75 US dollars. And of course, if it did that, both BHP and Rio would be negatively impacted. So a bit of headwinds there for iron ore. If we look to copper, copper is enjoying, because that's the other major commodity that they sell, it's enjoying strong demand, and mainly because of renewables. So copper is a critical element in solar panels, wind turbines, electric vehicle components, all those sorts of things. And the copper price over the past sort of year, up until just recent few days, thanks to Trump, it was up about 26%. So it reached north of $5 US dollars per pound, and now it's retreated. It's about sort of 450 or something now, but it's certainly benefiting from strong demand. And, copper is particularly attractive for these businesses. So it accounts for about 1/3 of BHP's revenue. And for Rio, it derives about 14% of its profit from copper. That's really an analysis or a discussion around the commodity prices and demand. Of course, the positive factor, as I mentioned, is the Aussie dollar is about 60 cents. So that makes our commodities relatively cheap by global standards. Now, if we look at the valuations, BHP and Rio are currently trading on a forward PE ratio of about 11 to 12 times, which is cheap, right? And below the long-term average. And I think the reason for that is that the market is kind of pricing in some risk here. Risk that iron ore price comes down, risk that China doesn't stimulate its economy. I mean, most of the market expects China to stimulate its economy, but to what extent is, no one really knows at this stage. And it's kind of priced into the current, I would say all that risk is fully priced into the current share prices of these two stocks. And actually, when you look at the dividend yield over the next 2 years or so, we're looking at dividends of about 6.3, 6.5% this year, and then 7 to 7.5% in the following year. So even if we don't see much in the way of changing capital value, at least investors can kind of pick up that dividend yield. Not the reason we're doing it, but at least, you get some level of compensation as shareholders. So if I own these two stocks, I think the downside's relatively limited. I think it's kind of fully priced into the current returns, save for any major dramatic change, of course. You never know what happens in the US with geopolitics and all those sorts of things. So I think all that risk is priced into the current share prices. You're going to get the dividend. So I'd be holding those stocks, and I would be thinking the miners probably won't negatively drag the index. They're either going to contribute to it or not, just might be neutral, really, but I don't think they're going to have a big impact on the index. So we just spoke about these 7 stocks, the 5 banks, including Macquarie, and then the 2 big miners. The issue is with the index, we've got such a large concentration risk. So those 7 stocks account for 36%. So really, let's call it a third of the ASX 200 index. So it does create a significant amount of concentration. And that's why I'm saying that we need to kind of form a view on what these stocks will do, because it helps us then form a view of what we might think the market cap index might do. And I've got a table on the website where what I did is I compared the sector weighting of the ASX 200 index to the sector weighting if we actually excluded these 7 companies. And it has a big impact. So, for example, the sector weighting, about 30%, 33% in fact, of the ASX 200 index is invested in financials. That's the big banks, of course. If we remove these 7 stocks I just spoke about, only 10% of the index would be in financials. And similarly in materials, which is the mining sort of sector, 19% is invested in the index. If we remove those 2 miners, it's 14%. Whereas consumer discretionary doesn't have a lot of exposure, only about 7 or 8%. Again, if we remove these 7 companies, we'd have 12% in consumer discretionary. So the problem is that these really large cap stocks are weighting ourselves to sectors or overweighting ourselves to sectors that we may not necessarily want to have exposure to, particularly given what I've just spoken about in terms of what their performance or returns might be. So I thought it was an interesting table to show you how this concentration risk actually skews your investments towards just a handful of sectors, and therefore then your future returns are going to be dependent on how those sectors perform. Now, let me provide you with a counter argument, because what I'm sort of saying is we follow traditional market cap indexing. These really large cap stocks now dominate the index, and that's a bad thing. That's kind of what I'm saying in this podcast. Now, what Vanguard would say, the second largest fund manager in the world, is that they would argue that large cap stocks have huge market values for good reasons. So they would say that large cap stocks are typically more stable, more valuable, and more profitable, and they're large for that particular reason, and that size generally aligns with solid fundamentals, consistent earnings growth, lower volatility, making it ideal for, someone's portfolio. So I acknowledge all those things, but that's assuming that the market is perfectly priced, and I'm not sure the market is always perfectly priced. So whilst I acknowledge that, and I would say yes, let's not have zero traditional market cap indexing. It's really just about how do we construct a portfolio to kind of accommodate some of these risks. If you want a different way of saying it, have a bet each way. Because I think it's important to say, yeah, okay, we get why large cap stocks exist, but valuations matter, right? So if all these large cap stocks are what we think are fairly valued or in line with their long-term averages, then I don't have a problem necessarily. But if we look at these large cap stocks, just like in the US, but if we're talking about CBA, for example, and we see that all these fundamental metrics point to the fact that, or to the suggestion that it is overvalued, then we do have a problem. I do have a problem with large cap exposure. Now, I put that to Vanguard in a meeting recently. They have to toe the company line. That's their house view in terms of methodology. But they did acknowledge, of course, that valuation matters in terms of long-term returns. And there's a lot of academic evidence and study that demonstrates that. Now, I've talked about the big banks and the miners because they're the stocks that we tend to find that clients tend to hold when they come to work with us. And so I wanted to really focus on them. But just for completeness, let's round out the top 10. Rio isn't part of the top 10 at this stage. So there's 4 stocks I haven't spoken about. So let's talk about them now. The first one is CSL. I mean, it floated in 1994. If you bought the stock when it floated, you've done incredibly well. Really, between 1994 and 2020, the share price was going gangbusters and you'd be crazy to sell it. It doesn't pay a very high dividend. It tries to reinvest its profits. But given 50% of its revenue is generated in US markets, I think given the current backdrop of tariffs and trade wars and all those sorts of things, and the fact that really shareholders haven't enjoyed any returns over the last 5 years, and that's not because of Trump. That's actually, we've had a Democratic government in place, and that should have been accommodating for CSL, given it's in the health sector, and it still hasn't generated great returns. So we think people should think about strategically divesting or reducing their exposure to CSL on the basis that returns haven't been poor. A unicorn isn't a unicorn forever. At some point, every stock fails to continue to outperform the general market. And we think there's some potential downside risk there, given its reliance on the US market. Next one is Goodman Group. It's like a REIT, if you like, but a little bit different than a real estate investment trust. It's performed really well, off the back a little bit of data center hype, really, but seems to be sort of fully valued. I don't know if I'd say it's overvalued, but fully valued on a forward PE ratio of about 26 times. We've got a neutral stance on that stock. We could go either way on it, really. Next one is Telstra. Telstra has been underwhelming for many decades. I mean, it's really just an infrastructure company. It tries to pretend it's a technology company, but it's nowhere near it. You just try and call them and use their technology and see how that works out for you. And it's tended to trade over the last sort of 25 years, somewhere between a range of like $2.50 and $6. I mean, it touched $6 a few years ago. I don't know if it's going to get back there. It's trading around sort of $4.20, $4.30. We think people should take their money and run. We think whilst it does generate an okay dividend, we think a more diversified approach would suit people better. And the last one that rounds out the top 10 is Wesfarmers. We think that's pretty fully valued too, around about a 30 times P ratio, but it's delivered great returns to shareholders over the past decade. Again, we're like Goodman. We're a bit neutral on that stock as well. So that gives you a bit of commentary on, the stocks that are going to dominate the Australian index, and therefore gives you a bit of an idea on, if the index is going to generate a return, where is that return going to come from? That's the question we need to ask ourselves. Now, Goodman could keep going. Macquarie Bank could keep going. You got Wesfarmers, they could keep delivering returns. But apart from that, you've got to be really optimistic to think returns are going to come from anywhere else. So that makes me think that, maybe investing in the A200 or VAS or just a general market cap weighted index fund might not serve us too well as investors. And so I'm not saying that we should eliminate exposure to those large cap stocks, but maybe just dilute exposure to large cap stocks. And there's 2 ETFs that stand out for me. There's MVW, which is an equal weight, ASX 200 equal weight ETF marketed by Van Eck. And then there's BetaShares X20, which invests in the ASX 200 except the top 20 companies. Both those are going to give you kind of more balanced sector exposure and definitely dilute reliance on those 7 large cap stocks I just spoke about, and in fact the top 10 stocks as well. Now, it's important to note that these ETFs will give you greater exposure to sort of small and mid-cap stocks, and small and mid-cap stocks generally do exhibit higher volatility over time. but they also do exhibit greater returns over time as well. So you've got to, if you're going to invest in those ETFs, MVW and X20, you've got to expect it's going to be a bit of a wild ride, more wild than the general ASX 200 index. But in the long run, if we're talking about sort of decade-long periods, actually should generate better returns. And I think if you're looking out through the rest of 2025 and even a little bit beyond that, you've really got to ask yourself, where are the returns going to come from in the index, given we've got so much domination by these large cap stocks? And I just can't see it beyond those couple of stocks like Goodman and Wesfarmers that I just spoke about. I can't see really where that upside's going to come from. And that's why I like to build a portfolio with some of those weightings to those other ETFs. Okay, a bit of a longer-winded one today. Apologies for that. Hope it's useful. Hope it's entertaining and interesting. And I think it's really timely because, if you're a little bit scared or shy of international markets, potentially Australia might be a little bit of a safe haven, although it tends to get dragged along with the rest of the world. I'm talking about that's in the short term. But in the longer term, most investors will have some exposure to the Aussie market, and it's really good just to think about, how that exposure might play out, not only over the next 1 or 2 years, but of course over the next decade. Running out of time for questions today, so I might just leave it there. Thanks a lot. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.